Hello, this is Jordan, and this video is being recorded on Monday afternoon, April 25th, 2022. Thank you so much for joining me today. If you're new to the channel, make sure you subscribe, as I'm going to have lots of great content on gold and silver, technicals, fundamentals, interviews with other experts who are smarter than me. We want to get you educated and prepared for what's coming over the months and years ahead, which looks to be a hugely profitable time for precious metals. But right now in the short term, there are some issues. And in this video, I'm going to discuss 3 leading indicators which are going to help us identify when this current weakness will abate and when things can really turn for good. And I've been talking about my macro view, which is the fact that gold and silver have not performed during this period over the last 19, 20 months when the rate of inflation has gone from 1% to 8%. So gold and silver did not perform during that period. And if we look at that as well as many other factors, it appears that the next catalyst is going to be the Fed stops hiking rates, obviously because there'd be more economic problems at that point, and then they'd have to go to cuts. And so that is going to be, in my opinion, the catalyst for the huge move higher in gold, probably in the second half of this year, maybe a little later than that. But that's what's going to push gold to that major breakout and a huge move higher amidst that breakout. So, you know, the potential leading indicators to really watch, I mean, the 3 of them are, we have the 2-year yield, we have the yield curve, that's difference between the 10-year and the 2-year, and then we have gold against the S&P 500. So these are 3 really good leading indicators to watch. And, you know, I haven't delved into maybe one is more of a leading indicator than the others. I mean, they do all kind of relate, as you can see, but, you know, looking at the 2-year yield, the Fed follows the market, and the 2-year is a proxy for the Fed funds rate. And so the Fed is hiking aggressively because they're way behind, and the 2-year yield has skyrocketed over the last, 4 or 5 months or so. And so that's telling the Fed, you better hike aggressively, you're way behind. Thus, they're going to hike aggressively. I mean, they do like to lag because that's how they are. But because of that, the 2-year yield is a leading indicator. The 2-year yield, it was a great leading indicator last time. It had actually turned down before the Fed's last hike in December 2018. The 2-year had turned down. But one thing to watch for, and I got this from Steve Savell, who's a great analyst. Steve, if you're watching, you're probably not. But if you're listening, please reconsider. I hope you'll do an interview with sometime. That would be great, but I won't bother you aside from this. Steve Savell, again, great point with the 2-year yield. He said, he had a post where he said, look for when it breaks below the 50-day moving average. So at the top there, I've showed some vertical lines in light blue of when the 2-year yield broke below the 50-day moving average. And you can see, look at what happened in relation to the yield curve, gold against the S&P, as well as gold at the bottom. Now, every cycle is different. Sometimes this happened, gold bottomed a month or 2 before, or it bottomed 3 months after. So, it's an art and a science, but there's a lot of art here trying to figure out the timing of exactly when this might happen and when things will turn. But getting back to the 2-year yield, the 50-day, we can see, I mean, look at those, look at those vertical lines and how they lined up. I'm looking at the gold against the S&P ratio, and I drew the arrows in there, and you can see when the 2-year yield broke below the 50-day moving average. All those instances were really good times to get long gold against the S&P 500. And also, it wouldn't have been a bad idea to be long, gold and gold stocks at that point. But we can see that, the 2-year yield turning lower and losing the 50-day moving average, that is obviously going to be very, very significant to watch for. And, next we have the yield curve. And we can see that, obviously the yield curve already inverted. It's steepened a little bit, but, right now the market is pricing in a 78% chance of essentially 3% Fed funds rate at the end of the year. That's by the end of the December meeting. So 3%. And that's actually a range. 3% is the midpoint of the range. But right now we're in a 25 to 50 point range. So that, the 10 years not quite at 3% yet. You can see the 2-year there. It's at 2.63%. So the market is pricing in all these hikes. And, we'll see. I've mentioned in the next 3 months, the market is basically pricing in 1.75%, which would take the Fed funds to 2 to 2.25%. And then it's a question after that point. I mean, how much more is the Fed going to be able to hike? Are they going to have to stop their hikes in the summer? Can they maybe hike once in the fall? I mean, we'll see. Let me know what you think in the comments. But that's going to be extremely significant, obviously. And in relation to the 2-year yield, because if we see the 2-year yield weakens, it starts rolling over a little bit, then it rolls over some more, that's going to be a signal that the Fed is probably going to have to pause. So that'll be something to look for over the next couple months. And back to the yield curve, when the yield curve steepens, that's when things really take off. And the steepening is usually accompanied by the first rate cut. And so if you look at the 3 vertical lines, in all those cases, if we're looking at if we're looking at all those 3 lines, and you look at the first line in the middle example there, in all those 3 cases, the first rate cut was, 3 or 4 months after that happened. You could say after the 2-year yield rolled over and went below the 50-day. So, and then of course, when those things happen, it's bullish for gold and gold against the S&P. So, these are 3 leading indicators that you can really watch. I mean, another one is long-term bonds. I mean, TLT. Yeah, you could look at the 10-year yield by itself, because if the Fed, the 10-year yield, I didn't look at it, but based on the yield curve, it's about 2.8%. If the 10-year yield it can't get above 3%. It falls a little bit. It's at 2.5, 2.3. And the Fed hikes in the next 3 months to 2.25. They're not going to continue to hike. Or else you're going to have a huge re-inversion of the curve. You can't have the Fed funds rate at 2.75% and the 10-year at 2.25%. That's a huge inversion. That's really bad. So the 10-year yield is also something to watch. Last thing at the bottom there, I highlighted gold and yellow as a potential comparison to where we are now. I'm not predicting gold's going to have that steep of a decline, but it's, the gold's got support at 1840. It's got the gap. It's got really strong support in the low 1800s. So I'm not that worried about gold. But, looking at that yellow circle there, it's more the idea that, gold failed to break out when the Fed was hiking. Then the Fed hiked some more. Gold had a sell-off, but the Fed stopped, and that was a major bottom. And so, looking out, I believe that it's sometime in the next 2, 3, 4 months, maybe even sooner than that, we're going to see the next low in the gold price. So there it is. Let me know what you think. You can follow all my work here, as well as at TheDailyGold.com. Consider a premium subscription. I overpositioned myself. I got a little excited in the last month or so. I thought breaking 1900 was the signal. Obviously, it's a false signal, but we're not that far away from when this thing is really going to turn in our favor. And if you have cash, consider subscribing, because there are going to be some incredible opportunities coming up in the next couple of months. On that note, thank you so much, and I'll see you again in the next video.